Now, fundamental analysis is one of the most important things you will ever need to know about the stock market. A portfolio built on fundamentals can find growth and stability during tough economic times. When most people think about the stock market, what they think about are complex charts and a whole bunch of numbers that they don't understand. But the real truth is that the stock market is not that complicated, okay? To make things even more simple, I broke fundamental analysis down into 6 different categories that you see in front of you here. Okay, now we have the financial statements. This is the financial records of the company, right? Records of the company's business activities and the financial performance, all right? This includes the income statement, the balance sheet, and the cash flow statement as well. Now, then we have the competitor analysis and the sector analysis. All right, you compare financial ratios, rates of return, also compare value. Which company offers the best value on their cash flow, or the best price to earnings or price to book, right? Which company gives you the best chance for stability? Which ones give you the best chance for growth? Which one is going to give you both, right? Then we have the catalysts and the economic advantages. Now, these are 2 things that speak to the future earnings growth, and how can these companies appreciate in value over time, right? Then what I'm going to do is I'm going to show you guys how to restructure valuations and how to calculate fair price and fair value, so that way you can get a fair value price and a price target, out of some of these stocks. Okay, now let's take a look at Contour Brands, for example. All right, now this is the company that owns Lee and Wrangler. I stumbled across them some time ago, I ended up studying the stock for some time. Since then, the company has grown and appreciated the value. But now here we are today. Use them as an example to see where they're currently at. Okay, now all of the data is going to be coming from seekingalpha.com. All right, so all of this data you see here is coming from seekingalpha.com. I snapshot the income statement and the balance sheet summaries, and I also pulled whatever else is needed from the cash flow statement as well. Now, for starters, let's talk about calculating returns, right? And that's going to involve your net income here, which is going to be something that's going to be very important. All right, when you want to calculate returns, you want to take your net income and you want to divide it by whatever you feel like you want to find a return on. All right. For example, let's calculate the return on debt. All right. So we have our debt right here. We have our net income. So what we're going to end up doing is we're going to end up taking our net income, which is 135.1 million. Okay. And we're going to divide that by our debt, which is 887, right? 0.57 million. And what we get is 0.1522, which is 15.2%. All right. That's the return we get on our debt. All right. And now what we can do with that is we can then measure that against other companies. I think it's important to know, based on the liabilities the company has, what kind of money is being generated. All right. What kind of profit is being generated from taking on all this debt? You see, they have a 661% debt to equity ratio. You better be at the top of the class in terms of the return on that debt, in my opinion. Now let's go through these other things here that we pulled out of out of Seeking Alpha in terms of, the information that we're going to need. So now revenue is your sales, okay? It's equivalent to sales. Now our gross profit, that's going to be our revenue minus cost of goods, and then our net income, and then our net income here, right? Our net income is going to be our revenue minus cost of goods sold, general expenses, taxes, and interest. All right. The current ratio is also important because it measures the company's current assets against its current liabilities. Now, current assets are assets that are due to be converted into cash within the next 12 months. Okay. The higher this number, the better. This number right here, our current ratio. The higher this number, the better, right? This means the company is generating more from their assets than they're spending for their liabilities. Now, the quick ratio is simply the current ratio, but they don't allow the company to include inventory. Okay, so I always consider it more of a cash measure of liquidity, and you can of course understand why. Right now, the company is free cash flow positive. That's great, but we see they have zero working capital because they're minus $183.7 million in working capital. All right. Now that basically means that current liabilities are outweighing current assets, and so we're being left with nothing to work with, and this could be one of the reasons why they're taking on so much debt. We don't know unless we investigate. All right. Now, gross and net margin are decent for their sector, upon my analysis. All right. It's important to know that you can measure these results. You don't have to scratch your head wondering if the company's net margin or other rates are good or not. Like you can simply analyze a company versus another company. So Seeking Alpha also have comparative analysis, right? If you go to the value or profitability tab for any company, you'll get these measurements that you see right here in front of you. Okay, what we're currently looking at are profitability comparisons. All right, now you have the company's gross margin, all right, and all other margins. You have the sector median, and you have the difference between the two. All right, now you want this number to be higher than the sector median because we're talking about profitability here. All right, now the gross profit, net income, and return on equity are the numbers I'm more concerned about as it pertains to profitability. These three numbers really give me a great idea of how the of how the company is really performing. All right, and we see that in these three areas, they're definitely beating their sector by far. Okay, what we're looking at now is the value tab. Now, you want this number here. Okay, you want this number to be reasonable in comparisons to the sector median or lower, being that what we're talking about here is value now, right? And what we're willing to pay relative to earnings, book value, and or cash flow. Okay, so that's something to think about. All right, you see our price to cash flow here. All right, now We can at times, if we're dealing with a company where sales numbers is a major factor in their operation, just want to point out that we could also go with our price to sales ratio as well. And we don't have to use every single one of these ratios, guys. We can pick one or two that helps us to make our decision and say, okay, this is where I want them to be beating the market. All right. Now, one thing that I would also recommend is comparing the company with 3 to 5 companies, within their sector or their industry. All right. And the 3 to 5 largest ones would be my preference. All right. Now, the next things we want to talk about are the catalysts. All right. Now, a catalyst is an event that causes the price of a security to move, sometimes significantly. Examples of a stock market catalyst are company earnings releases, investor analyst days, analyst revisions, product launches, management transitions, significant dividend changes, significant stock buyback changes. In a simplified sense, it's good news or press release to get people interested in the stock again. All right. Now, stock catalysts often change investor sentiment and can mark the beginning or end of stock trends. They may affect the perception of a company's discounted future cash flows. All right. Let's take a look at a random example. So the Wall Street Journal posts an article about supersonic travel. Right now, the companies in this article are spoken of as the top in the industry. At the same time, travel is given the additional boost from the reopening. Now, these are catalysts for growth and a reason to speculate about an increase in earnings, right? Now, this may potentially lead to an increase in earnings estimates as well, right? So this gives us some catalysts for growth here, along with whatever else we feel like we're seeing, all right? Next, in our evaluation, so we've looked at the finances, right? We've seen what we've seen there. We know what our return on debt is. We know what our gross profit margin. We also want to dig into the actual balance sheet, look at those current liabilities and current debts, and current liabilities and current assets. And so I think it's going to be important to run that return on current liabilities that we spoke about as well. How much is the current net income covering in terms of their current liabilities? It's important to know that. Okay. Now, but once we've seen what we need to see from the financials, and we've done a comparative analysis, we've looked at any catalyst. Now it's time for us to re-evaluate the company, right? We're looking at the price that we saw, right? And we're saying, is that the right price? Am I paying too much for this company at that point in time? Now, valuation, right? Your PE or your price to book, those multiples are really great to go off of in terms of conversion, because we can look at it from a sector comparison. We can look at it from a company comparison or a historic comparison, and dial things down a little bit to see what would we be paying if this company had a more reasonable price to earnings and price to book ratio. We'll talk about that more. Okay. So then you have your future earnings, which you're going to use to calculate potential fair price, and also to calculate a future price projection for yourself if you decide to do so. Okay. Now, here you see the key elements from Contour Brands to find a new fair price or a price target. All right. If you look at the current PE ratio right here, all right. If you take a look at the current PE ratio and multiply it by the 2022 projected earnings right here, right? You have a 1-year price target. So let's go ahead and do that. All right. Again, you take your price to earnings, your current price to earnings, and you want to go ahead and you want to multiply it by your future earnings to get a price target. All right. Again, it's just a price target, so it's like, what were you thinking might happen? All right. So that's 26.57. All right, and you want to multiply that by 4.27. Okay. And so I get 113.45. Okay. And that's something for us to think about right there. Could we potentially see it going to that price within 1 year? All right. You could also cut the valuations, like the price to earnings or the price to book, to find a more fair value relative to competitors or to the sector. Let's say the sector average PE was 13, right? Now, you could take that and multiply that by the current earnings, right? These are your earnings right now. Multiply that by the current earnings. This would show you what a more fair share price would look like. So, on one end, with what we did before, you're creating a price target, and here you're creating a more fair current price, right? So let's try this. So we said our sector PE was 13. So we're going to replace that here. All right. So 13, multiply that by our current earnings per share. Okay. And we have $50.05, right? Our current, right, is here. So if we were looking at paying a better price to earnings, we might set our entry point here at around $50, right? Now, sure. What happens if the company isn't trading toward that fair value that you have? Why is this important, right? So for starters, the share price from Friday, this share price right here, is from Friday, May 14th. All right, now this video is being recorded on Tuesday, May 18th. This company is now trading at $63.78 per share. Okay. The company is down 2% today. So I don't think this is a coincidence. In fact, I believe if you realize the company was overpriced or overvalued on Friday, you would have avoided the purchase on Friday knowing that this stock could drop, right? That's not just due to overvaluation, but remember, they're also receiving downward pressure due to interest rates and inflation threats, right? So you have other reasons to believe that this stock can come down as well. So that's just something to think about, all right? So let's just go over this one time here. What is fundamental analysis, right? So fundamental analysis is about determining a stock's fair market value, right? Analyzing the financial statements and any other factors that could influence its stock price in the future. This form of analysis also considers the overall state of the economy and factors including interest rates, production, earnings, employment, GDP, and housing. Fundamental analysts, they study anything that can affect the security's value, from industry conditions to microeconomic factors like the effectiveness of the company's management. All right. Now, the end goal is to arrive at a number that an investor can compare with a security's current price in order to see whether the security is undervalued or overvalued. All right, now what matters most is the analysis of a business's financial statements and their market competitors. All right. To break that down even more, let's go with 3 keys that you really want to focus on. All right. Now, first, is the company profitable and are they debt friendly? Right. What's their return on debt like? What's their debt to equity like? Do they have the cash flow and the equity that's rising and that's keeping the company afloat? Are they valued at the correct price? Okay, these are the things that you really want to focus on. This is where the valuations, the profit margins, and the investor information comes into play. Right now, we dig into the cash flow statement, the balance sheet, to see if the company has what it takes to run. We revisit the valuations and determine if the company has the right price for you. Okay, so this is how you work. All right. Now, I do also want to point out we got an ETF alert. All right. Brand new ETF just came out. That was this Friday as well. It's from 6 Meridian. All right. They combine exposure to both the quality and growth factors of stocks, a strategy that's focused on owning the quality piece of the growth market. Now, this is a statement that's coming from the company, not from me. I'm definitely not saying just go out and buy this thing. I'm just saying a new ETF just dropped and I just got an alert and I want to make sure you were aware of it. Catching an ETF in its beginning stages can really lead to great capital appreciation if you put a certain amount of money into it over the first few weeks and then just let it run, or if you continue to invest in it over time, whatever you do, as that ETF grows, as most do. Most ETFs do not tend to trade below their IPO price. Okay, they're focused on a lot of companies that help to move the ETF. Okay, but that was it for our exercise today. I'm hoping that everybody is understanding what we're talking about here, right? Let's go back to our 3 keys. Are the companies that you're looking at profitable and debt friendly, right? Do they have the cash flow and the equity growth, right? Are they valued at the correct price? I also want to tell you, dig into that balance sheet, find the retained earnings, okay? Is the company retaining any of their earnings? That's super important, right? Free cash flow and retained earnings, I think, are 2 things you should keep your eyes out for, okay? Followed closely by working capital and return on debt, all right? Then you look at the valuations, your PE, your price to book, and you say to yourself, well, am I paying too much for this company? Is this a fair value, or am I getting a discount? That's essentially what you're saying here. All right. So I just want to say thank you for everybody that tuned in. Please note that I am not telling you what to do with your money. This is not financial advice. This is just financial information. If I don't see you in one of our morning classes, stay safe, trade safe, and always do your research. All right. Be sure to follow Stock Market Academy on Clubhouse, people. Much respect.